Section 2. Why the housing market crashed. Don't default. Melissa left David's office with far more confidence than when she had walked in. She understood something many homeowners never realize. The foreclosure wasn't the beginning of the problem, it was simply the result of a default that had started much earlier. The following afternoon, she completed the listing appointment. The seller wasn't behind 6 months on the mortgage like Melissa had imagined. In fact, she had only missed one payment. On the drive back to the office, Melissa couldn't stop thinking about what David had said. The earlier someone asks for help, the more options they usually have. When she returned, David was standing in the break room, pouring a cup of coffee. "So," he asked with a grin, "how did it go?" Melissa smiled. "I think we caught it early." David nodded. "Good. Because 20 years ago, most of us didn't." Melissa laughed. "You mean during 2008? David leaned against the counter. "Everyone talks about the housing crash. Very few people understand why it actually happened. The scary part is, it wasn't one bad decision. It was thousands of bad decisions made over several years." David walked over to the conference room where an old market chart still hung on the wall. Back then, everyone believed one thing. Real estate always goes up. Builders believed it. Lenders believed it. Wall Street believed it. Consumers believed it. Even experienced realtors started believing it. Melissa looked at the graph. The prices just kept climbing. "They did," David replied, "and that's exactly what made it dangerous." As appreciation accelerated, lending standards became increasingly relaxed. Borrowers who would not have qualified for traditional financing only a few years earlier were suddenly being approved for mortgages with very little documentation. Adjustable rate loans, interest-only loans, stated income loans, and other high-risk lending products became commonplace. Many borrowers assumed they could refinance before their payments increased, while lenders assumed rising property values would continue indefinitely. For a while, everyone appeared to be winning. Homes sold quickly, equity grew rapidly, investors purchased multiple properties, builders couldn't build fast enough, lenders originated record numbers of loans. Then the market stopped climbing. David looked at Melissa. "What happens when people buy homes they really can't afford, and prices stop increasing?" "They're trapped," Melissa answered. "Exactly. Many homeowners suddenly discovered they owed more than their homes were worth. Adjustable rate mortgages began resetting to significantly higher monthly payments. Refinancing became impossible for borrowers with little or no equity, and selling often meant bringing money to closing that many families simply didn't have. The result wasn't simply a decline in home prices. It was a wave of mortgage defaults that quickly became trustees' sales, foreclosures, bankruptcies, and short sales throughout Arizona and across the country. Melissa thought for a moment. "So the market didn't cause the defaults?" David smiled. "No. The market exposed them. Most of those loans were already headed for trouble. The declining market simply removed the escape route." That distinction changed the way Melissa viewed every distressed property she had ever sold. The housing crash wasn't caused by one event. It resulted from a combination of speculative buying, overly aggressive lending, risky mortgage products, inflated home values, and the widespread belief that appreciation would solve every financial problem. When that belief disappeared, the entire system began to unravel. The collapse also exposed another problem that had received very little public attention before 2008: predatory lending. Some borrowers had been placed into mortgage products they didn't fully understand. Others were encouraged to repeatedly refinance loans simply to generate additional fees. In some cases, borrowers were approved for financing without a realistic evaluation of their ability to repay the debt over the long term. The financial crisis prompted significant regulatory reform designed to improve transparency and strengthen consumer protections. Congress enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act, which led to the creation of the Consumer Financial Protection Bureau, CFPB. The CFPB now oversees many federal consumer financial protection laws, including mortgage disclosure requirements and regulations intended to reduce unfair, deceptive, and abusive lending practices. David looked at Melissa. "Here's the biggest lesson every realtor should remember. This business isn't about predicting markets. It's about protecting people. As agents, we don't underwrite loans, interpret tax law, or provide legal advice. What we do is recognize warning signs, ask good questions, educate clients about the real estate process, and encourage them to work with qualified lenders, attorneys, accountants, and housing counselors before small problems become major ones." "So this class really isn't about what happened in 2008. David laughed. "No. It's about making sure we never ignore the warning signs again." Online discussion question 1. How did the belief that Arizona home values would continue rising contribute to the housing market crash? Answer: The belief that property values would continue rising encouraged buyers, investors, lenders, and other market participants to take greater financial risks. Some borrowers accepted loans they could not afford long term because they expected to refinance or sell after the property appreciated. Investors purchased multiple homes based primarily on projected appreciation, while lenders approved increasingly risky loan products. When property values stopped rising, many borrowers lost the ability to refinance, sell, or escape unaffordable mortgage payments. Discussion question 2. Why did declining property values expose problems that were already present in many mortgage loans? Declining property values did not create every loan problem. In many cases, the underlying risk already existed because borrowers had been approved for loans with unaffordable future payments, weak documentation, adjustable interest rates, or little financial cushion. Rising values had temporarily hidden those weaknesses by allowing borrowers to refinance or sell. Once values declined, those escape routes disappeared, exposing the true financial instability of the loans. Discussion question 3. What should an experienced Arizona real estate agent do when a buyer appears confused about the long-term cost or structure of a proposed mortgage? The agent should avoid interpreting loan terms or giving financial or legal advice. However, the agent can encourage the buyer to ask the lender detailed questions, compare available loan products, review the loan estimate carefully, and consult a qualified mortgage professional, attorney, financial advisor, or HUD-approved housing counselor when appropriate. The agent should also document important communications and avoid pressuring the buyer to proceed with financing the buyer does not understand.